Happy New
Hi,
Year, Lakshman, up
hi,
there,
Dale.
and
How are
you're,
you?
you're fine. It's really nice to be talking to you today, Lakshman. I
You
mean,
too. Happy New Year. I was muted before when I said that, so I'm repeating it.
okay, all right. Well, speaking of New Year's, been looking forward to hearing what your narrative is, and with everything that's kind of changed in the last couple months, at least interest rate wise. Tell us what you're thinking going into 2024. Has your forecast of a hard landing been revised? I mean, you might be the only one left if it hasn't.
Well, I'm open to it. I
Okay.
haven't seen um last time we spoke, Dale, I'm sure I was talking about the tug of war between the cyclical forces to the downside, and those actually persist, uh, being offset by these non-cyclical um, elements that really came to the fore in 2023. And by non-cyclical, I mean uh, you could have something big and structural like what happened to the labor market with labor market shortage, or you could have a lot of one-offs, policies or injections of spending that um, are they don't look persistent. They look like one-time events.
Like
Uh,
COVID, responses to COVID. Is that
those
what
kind of
you're?
things, right? So
Yeah.
stimmy
Okay.
checks or some of the fiscal spending. Um, if you look at kind of the ebb and flow of the size of the deficit, for example, the kind of deficit spending that we've seen um, over the last couple of years is the type you would see inside of a recession, right? So
Okay.
typically, this that kind of government push happens in reaction to a recession. Here it is happening perhaps before, because we have, there's been some pretty big
Yeah.
spending packages that have
Still
gone
in the
out.
pipeline. The
Some are still
inflation.
so much
Yeah.
that the pipes got clogged, right? So it didn't all, there weren't enough so-called shovel-ready kind of places to put the money. And so I think some more of that'll happen in 2024. Maybe they'll push some of the money that wasn't spent out to state and local governments, that kind of thing. I think that'll probably happen. But the thing is it accelerating? Is it decelerating? And how long can it go on? That's because that's not a sustainable kind of plan, such as it
Okay.
were. So we enter into
Let me ask you this before we
24.
get to that. We had the D's Fed meeting, and I'm sure that the Fed and his governors also see what you see. Maybe they look at it differently.
Look at it
But
differently.
a very important part of the year to keep consumers confident, wasn't it? Right before Christmas, where people have taken their revenge vacations in the summer and taking on huge debt, record consumer debt,
Yeah,
and
you see
just
it.
to
I mean,
get,
you
yeah,
really saw a blowout in consumer borrowing.
yeah. I mean,
And is
isn't that
that,
on it? It's afterburners now.
well, yeah, you could, I guess, it depends which side you're on, right? You could say, that is a sign of huge confidence. We're reaccelerating. Or you could say it's afterburners. It's a sign of desperation. They're trying to maintain spending that they are used to, but can't afford. Uh, and and which one is it, right? So that's why um, stuff like credit or some inventory stuff, it could be read either way. Is it building because nobody's buying stuff, or is it building because the managers are so optimistic about what they're going to do that they want that inventory? And that's where having good leading indexes, which have indicators away from those measures, you want to see if they're corroborating or not, or not. And in this instance, look, there's no reacceleration in sight. That's the tug of war that's going on. And so I think that that's the story of 2024. How is that going to end? I'm telling you that the cyclical forces are still pushing to the downside. Non-cyclical are pushing back. Who's going to win? How is that going to play out? How long can the non-cyclical push back? Can they do they have any more gas? Can they accelerate the non-cyclical to offset the cyclical impulse to the
Well,
downside?
hasn't the Fed tried to repeal repeal the nature of cycles many times in the last
Yeah, and I'm not
10,
even
20
sure.
years?
Yeah, and I don't even know if that's a great idea, to tell you the truth. Look, I'm not wishing for recessions in the sense like I don't
Yeah,
want harm to anyone.
yeah,
There's collateral damage to the most vulnerable in
right.
those situations. On the other hand, in a free market oriented economy, it's a feature, it's not a bug. You're supposed to have recessions. They do positive things for the health of the economy in the longer run. It sets it up for its next phase of growth. And so if you skip that part, it's going to cause probably more extreme situations down the road. And that's one thing that I would question about a policy which starts with any recession is the end of the world. It isn't. So going into just reading the tea leaves, reading the cyclical tea leaves, I'm going to say that the market's kind of priced for perfection. We're gonna stick the soft landing of some sort, and inflation's going to come down toward the Fed target and kind of hang out there. That's the basic backdrop that the market's trying to hang on to. Um, so in looking for the risk to that, on the growth side, I'd say, whoa, I think the risk is still to the downside because of this tug of war we just described. And mind you, when the cyclical impulse is still to the downside, that's when your immune system's a bit compromised, and you're more susceptible to negative shocks. And there's plenty of them that are floating around. I don't have to list them all. We'd be here all day, but uh, kind of looking at some of the things being fired at our Navy in the Middle East gives me a little bit of pause. Um, then on the inflation side, uh, I do question this idea. Look, we've said inflation is in a cyclical downturn, fine, and then that continues. And I think when I was getting on the call, you're talking about the next CPI print. Yeah, it's probably going to be weaker. That trend will continue. I don't think you're going to see a break in trend anytime soon, not imminent. Having said that, our future inflation gauge, which looks at inflation completely different than the Fed, completely different than a lot of inflation forecasters. We're not extrapolating the recent past. So the expectation that inflation is going to keep falling or go down to the target or whatever and hang out there is based on it coming down over the past 1, 3, 6 months and
Right.
extrapolating that into the future. That's fine as long as inflation isn't cyclical. But my entire career of research, building on that of my mentor, uh, concludes just the opposite, that inflation is cyclical. So it's very dangerous to extrapolate the recent past of something that is cyclical and say, therefore, it won't turn. I think that's a
Yeah.
dubious prospect. So, looking at forward-looking indicators of inflation, not extrapolating, looking at leading indicators of inflation, what turns ahead of cycle turns in inflation, um, those indicators came down and they continue to go sideways. It's over a year they've gone sideways. And when you kind of decompose recent parts of the CPI and look in there. The thing that sticks out, you don't have to look too hard, is wage inflation.
Oh, you're talking
And
about the completely phony index, CPI?
well, you could call it that too. Look, I mean, I'm gonna. be nice and say everybody's trying to play fair and trying their best. But you're right. It doesn't comport with what we all experience,
Right.
right? And so I think that is a real thing. But it is what it is, and it's what we have to play with. So we're looking at the CPI and what it's constructed, what are the ingredients going into it. And it's wage inflation is sticky, and we know why, right? Again, it's because there's been this structural knock on the size of the labor force, which has uh, there's a lot of backdraft from that.
Yeah.
And when we go into what's going on with employers, they continue to do labor hoarding as long as they can. They're pulling every other level. The work week is way down. It looks recessionary. Temporary jobs growth way down. Looks recessionary. Part-time versus full-time. It looks pretty scary. Then you look at a classic stuff like where are the jobs that are growing? Well, they're easy to see. It's in education and it's in healthcare. And that's growing in 2023, that was growing at a 4% clip. The thing is, that's non-discretionary services.
Right.
Anything else where you have kind of a choice, it's super weak. And the rest of the job market is pretty darn weak as a result. One place where you would have had, I think, negative jobs growth in 2023, which we didn't, was non-residential construction. Typically, that would slam down pretty hard. But if the government steps in and says we're going to support the
Yeah.
building of factories all over the place, then
Right.
you're going to employ people to do that, and that happened.
So
And
very
continues
different.
it continues to happen. The thing is it's not accelerating. In
Okay.
fact, it's decelerating. Sorry,
Okay.
go
All
ahead.
right. So I mean, so these are things that I mean, can you say that this is rear view mirror stuff that may be underestimated? What how long this was going to be postponed because of these one-offs, as you described,
Yeah,
lasting?
yeah. I
I
think
mean, you're human, right? I mean,
yeah. So leading
we don't,
indicators. So I mean, either there's going to be some sort of shift in the narrative to the downside
yeah,
toward what the cyclical indicators had said, or um, they got the slowdown right, but they didn't get the magnitude right, right? It didn't go
right,
into recession. And
right,
so, and I think the culprit, right? Ever since the reopening, uh, on your show, I'm sure, and when you consume and look at analysis, there's all these record breaking charts
yeah.
to
You're
the
talking
upside
about,
and the downside, right?
yeah,
They're just like either to the moon or straight through the floor. And and that is all, I think, pretty closely related to the violence of both the lockdown, where so on your charts, all your activity and employment numbers just, they go to minus 20 or
yeah,
something, right? And
right,
then when you have the opening up, even without stimulus, it would have popped. Okay. So then you throw a lot of turbocharged fuel fuel on there to turbocharge it, and it just went bonkers. And you throw on their supply chains and all that, and the labor force being constrained, and this is what we get. So these indicators, I think, have done a very good job, and their strength has always been direction. Uh, Magnitude, that's a secondary kind of conversation. And so
right.
that's the difference between, hey, we had a sharp slowdown and we had a
2-year recession.
recession.
Yeah.
Yeah. So I think that's a thing to keep in mind.
Speaking
I want
about,
to,
go,
yeah.
you wanted to show something because
Yeah.
I do want to cover when you talk about one-offs. Do your leading indicators have some type of presidential cycle
Hmm.
pattern to them? Because I know we're having an election and it's,
Yeah.
well,
I've dug
maybe,
around on that.
maybe.
Now
maybe
I'm
what?
gonna go all the way back to like the 90s and stuff, because when we were at Columbia University at the business school, we had a researcher once, a kid, not a kid, a young man,
Yeah.
who was studying that and wanted to look at that with cycles. And we couldn't find, first off, in our leading indicators implicitly, look, if they go out, let's say the administration goes out and spends, $5 trillion, it'll show up in the indicators, right? Because there's market prices in there. There's confidence numbers, survey data in there. So it'll show up. Okay. So to the extent it's going to impact the direction of the cycle, implicitly it'll show up. But what we found, when we tried to look at all our cycle stuff and see how it linked up with um, elections, presidential elections, slightly different statement. What came out of it was that if the coincident index was higher, the level, right now this chart I was showing you for a different reason is growth rates. But if the level of the coincident index is higher than it was at the start of the previous downturn, then the
Okay.
incumbent wins.
Okay.
So that's going to be really tricky with all the stuff that happened with COVID. But up until then, that had been the relationship, and it kind of echoed. You may recall, Dale. I don't know about everybody else. Reagan, who had a slogan, and he's like, "Are you better off today than you were 4 years ago?"
Yeah.
It's an echo of that, right?
Okay.
But shown in the data here,
I think there's a
it
small percentage of people that feel that way. It gets to be smaller and smaller, I think. Really, don't we
yeah,
have a
yeah. If you have a lot of
bifurcated
assets, you're feeling fine.
economy? It's like a tale of two cities. It's the best of times and the
Yeah.
worst of times, and the people in food lines and
No,
sleeping in their cars, let them eat cake.
I hear you. And the other thing that's pretty scary, right? And this happens
And
in
these are during good times,
yeah,
supposedly.
these are look, I mean, I don't know how much. I thought $9 trillion in debt was a lot, and now we're at 33 or 4.
Yeah,
So for me, I'm like, this, I'm like, okay, I am prepared to be surprised by that number going up further. Um, but I think there's, I don't want to get political at all, but there's a lot of change, right? The world is changing. When you have, it's not like this east-west world that we used to have a half a decade ago. It's a
yeah.
more
It's bipolar
cohesive,
now.
holistic. Yeah, and so you have that. Maybe some of the, it's China versus U.S. instead of USSR versus U.S. There's some of those things shifting, and then there's the technology shifting. I'm
Yeah,
sure it was
AI.
very. I'm guessing it was really disruptive to go from agrarian to industrial.
Yeah,
It's been pretty disruptive, right? We've gone from manufacturing to services.
right.
Then we're kind of sliding from services to information services. And then who
I'm a
knows how
I
AI
I'm a
floats into this.
hologram. I'm
Yeah,
really
you're a
not here.
hologram. I'm a hologram, right? I mean, yeah, no. If you start going down to like what's going on in physics and quantum mechanics and stuff, you're like, yeah, we're all holograms. I don't know. We're not going to go there. But here on on the on the current state of affairs, this is like if it's possible to have an honest referee. Okay, I know
Yeah,
we all watch. Some of
because
us watch sports or whatever. We're like, hey, that's not fair. That's a
yeah,
bad call. But
too
look,
much laundry on the field. Yeah,
yeah, yeah. So look, this is the coincident. I'm really getting back to basics. This is the coincident index growth rate. And so it includes the indicators that define the economy outside your window and
yeah,
how is it doing. And that's we've said it before, but it's all kinds of production measures like GDP and industrial production and things like that. All kinds of employment measures, the headline numbers, the unemployment rate, different types of aspects of basically what's going on with jobs. And then Sales numbers, much broader than retail sales. It includes that kind of stuff, but manufacturing, trade sales, really big national sales numbers. And then finally, income numbers. What are all these enterprises and individuals earning? What are they pulling in? So that taken together is what is our economy. That's how we define our economy. That's how we know if we're in an expansion or a recession. It's not simply GDP. And so I know, for example, well, so here, let's just get some highlights out of here. We almost went to 20% growth rate coming out of COVID.
Right.
Okay. That's a big number. Okay.
It's historic.
Everything's gonna get slammed and crazy. Okay, so then we're sliding down. We get to this low, and in 2022 there was a hard landing kind of priced in, right? And we get to this low of say 1% or so, just about here, of all output, employment, income, and sales. And if you'll remember back here, there were a couple of negative quarters, I think, of GDP. Okay. Then we cruise along. We're getting a lot of jobs growth in here, and we get a blowout GDP number here. Okay, and this is where all the stellar jobs growth was happening. But look, to my eye, and we could debate this,
Flat.
yeah,
It's an
languishing. I don't know.
EKG of a dead man.
I don't know. And when you tell me, whoa, we did deficit spending like we did in a recession during this period. I'm like, oh yeah, I'm not sure if you got what you paid for, right?
Interesting.
Um, so so this is that cyclical impulse to the downside, not even looking forward in our indicators. This is just the adding up of that data. So I'm not cherry picking. I'm not saying, oh, I'm only going to take the things that are going up. I'm taking, there's four big items. They're in there. We have not changed anything about how that's run. And that is the way, that is what the economy is outside our window. So the question here is, okay, is it going to keep languishing? Is it going to deteriorate, or is it going to reaccelerate?
Doesn't that depend on whether or not we've made a pivot with the Fed and they start taking rates down again, Lakshman? Or will it this time be pushing on a string?
I think I don't want to underestimate the power of the Fed or the federal government to get in there and give it a boost. As I said, post GFC during the whole QE stuff, I was kind of surprised with the amount of getting to Q eternity and all this. And so now we are a little bit, you could see it. I haven't really gotten into the weeds. I don't do too much with the Fed. I kind of predict inflation and growth, and then I say, that's going to force them to do something. But if you look at a few of them, the Fed heads have been out the last couple of days, and I think they've tried to talk down a little bit on the cuts, and then they've also focused people in a bit on the reverse repo and stuff like that.
Okay.
And so this unwinding of what they did in the financial plumbing is at hand.
Yeah.
So if your view is that we've stuck the soft landing, implying some sort of acceleration, right? Because you're pivoting, or no landing, we're still growing, or we're going to grow more. Then as a policymaker, you have to say, yeah, let me get rid of all the emergency stuff I did, and let's not worry so much about inflation because everything's Goldilocks. Our indicators are saying we don't see a reacceleration in this line, and separately on inflation, we don't see this huge drop in inflation, and that's tied to wages really hanging in there. The One of the ones I watch a number of different wage indicators, but one of the ones you could watch is the Atlanta Fed. It's a coincident indicator, wage tracker, and so it hits a high of like 6.7 or something a year and a half or so ago, and it's down. It came down to like the low 5% growth rate, and then it's kind of flattened out for 4 months.
You know,
And
Go ahead,
Yeah.
Lakshman. Go ahead.
I was
Finish
just
your
going to say,
thought.
and if you open the paper, a lot of businesses have striking workers.
Yeah.
The leverage is there
Yeah.
for the time being.
Yeah. Unions
Um,
haven't been this active in many, many years, and they all won. They all
yeah,
got what they wanted. And,
yeah,
I'd say my biggest takeaway from what we've talked about today is the fact that even though the market is getting some good numbers on CPI
yep,
and PPI, you're seeing inflation not really declining, but holding. And perhaps, just like the 70s, we have another burst of it. There were more than one inflationary episode in the 70s. There you go. So
yeah.
maybe we're just coming out of the first one from 1970, and then we had a year it cooled off, and then
Yeah, the black
74.
line, yeah,
Yeah,
that black line is your 70s inflation.
right.
And so I think the one thing it demonstrates
Three, a number of
is that
completions.
it
Three.
cycles. You
Yeah,
see, look, we are in a completely different economy. I know all of the objections about why the economy today is not the economy in the 70s. My point on this chart is different. It's that inflation itself, the story behind it can be different in each cycle, but inflation itself is inherently cyclical.
right.
And so where are we? That's always the question. Where are we, right? So here's our gray line is the 2020s. And so we've had this huge run up, this spike up to 9 something percent inflation. And then now
Mhm.
we've fallen down to between 3 and 4. And the
Higher
expectation
highs,
is that,
higher lows.
well, the expectation is we're going to go down to 2.
Yeah,
We're going to go down here and then we're going to stick it.
yeah. It's going to
And
flatline.
and I'm just like, okay, I think you can hope for that, but I don't see why it must do that. And when I look at forward-looking indicators, not these indicators, this is just the referee, the coincident data. When I look at the forward-looking indicators, they came down,
Yeah,
anticipating this decline, but then they've gone sideways. And that means this is not apt to decline down to 2,
right.
or certainly not to stay there. So I get worried about higher lows. And remember, it's hard to remember, but think back. Arthur Burns is working in here. He's in the early 70s.
Right.
And there's a real trade-off in the public's mind between inflation and jobs, right? You want to have your cake and eat it too. You want a lot of jobs with no inflation.
But you have your dollar that you're earning means something.
Have your dollar is so it gets you're in this tug of war. By the end of this period over here, when
10
Volcker is in
years.
there,
Yeah,
so
10
Volcker's
years.
in there. The difference between Volcker and Burns, one of the things, they're very different people, but the one of the things to understand about them is they had a different public perception of inflation. When
So who's
Volcker,
Powell? Who's Powell? He wanted to be
well, he wants to be
Volcker,
Volcker. He said, "I want to be Volcker,"
but he's
but
acting like Burns.
well, with this last piece,
Yeah,
with December meeting, he's a little more Burnsian, right?
yeah,
And
he is.
so part of it is that public pressure from the outside, there's or from Wall Street that
Or
nobody
or
wants rate
the
cut,
White House in an
or the
election
White
year.
House, all of them.
Yeah. Okay, so
So everybody's talking their book. Our book
right.
is look, I think this thing is cyclical, and so I'm not going to bet that it just keeps going in a straight line down.
All right.
I think that's the
If
main
we,
point
if
of
we
it.
ever had a bottom in the oil market, that would happen. But I've heard it people say that there's deflation in the things we own, which right now isn't happening because if you own stocks and you own real estate, there is, they're going up too. And the inflation is in the stuff we use that you
Food.
always have to replenish
Yeah.
so you don't run out. And the grains have been under pressure since, and they're starting to turn up. There are commodity markets that were out of favor. Food prices could be the next part of it, I think, Lakshman.
Yeah, I agree. And I think when I look at 2024, we are seeing some kind of tentative signs of cyclical bottoming in Europe.
Yeah,
Uh, and we are seeing some, we're on the watch for some cyclical bottoming
in
in,
China.
yeah, maybe in China, but it's more broadly in global industrial growth, which has
Okay.
been really taking it on the chin. And it's quite extreme in the sense that in the wake of COVID, the amount of time of that downturn has been pretty significant. So it's about time that it would start to bottom. And so we're seeing some inklings of that, which could begin to support something like oil prices, but that could take a little while.
Yeah, yeah.
Okay. That
All
could
right.
take a little while. So those are some possible pivots, but all that kind of stuff is not great for the Fed.
Okay. So, and if the dollar turns south, Lakshman, we had a strong dollar regime. It's recovering
It's
now, but it's
inflationary.
still, yeah,
Yeah.
nominally at least.
This and to be clear, we've just been talking this morning about cycles, which is looking out a few quarters. Structural stuff is quite different. Um, if we don't have a recession, right, or a hard landing, because those can help bring prices down more. Um, You've got your onshoring, you've got your tight labor supply, you've got all kinds
Issues.
of issues that are structural. You don't have the China price you had post GFC, where they exported disinflation.
Right.
So without those kinds of things, higher lows in the inflation cycle, that's not a stretch.
Here's the headline of the interview. Lakshman says inflation is not dead, only taking a rest.
It took a
Right?
cyclical rest, a
Yeah.
temporary. What did the transitory? What did he call it? Powell called it
Oh,
transitory.
yeah,
Yes.
transitory. Well, I'll tell you what, there's never been probably a more important time than what happens this summer or fall in both the economy and stock market to determine the
Dale,
fate of our country.
Dale, they are, and right now, the Fed with the pivot in December and the ECB are signaling, hey, yeah, we'll be cutting later this year.
Yeah.
No problem. And I just want to keep an eye on that inflation cycle
Okay.
because if there's no recession, then it probably fuels the inflation cycle to the upside.
Yeah.
Uh, on the other hand, if there is a recession, then that's a whole other thing to think about.
Right. Well, it was great catching up with you,
Yeah,
Lakshman,
you
and
too. I'm glad to touch base with you at the beginning of the year.
yeah, and I hope 2024 is a outstanding year. Your best year ever in all ways for you, your family, your coworkers.
I really do appreciate that, and the same to you. And hopefully we can, just learn or improve riding these waves.
Okay.
You
Get
know,
your
and
I'll get my
staying
longboard
engaged.
and
Yeah,
we'll head out. All right, Lakshman.
longboards are safe.
I
Thank
I
you.
I recommend people that you follow Lakshman
Yeah.
at the Business Cycle and go to
businesscycle.com
yeah,
or you can pick us up on LinkedIn and there's a newsletter.
yeah. Especially if you own a business and that these things are going to be important for how what kind of position you're in if and when certain things happen. Do you have a lot of inventory? Should
Hmm.
you be trimming some of your labor costs? Lakshman can help you out with that. I appreciate it, Lakshman.
Thank you, man.
All right.
Bye
Okay,
bye.
everyone, that's a wrap. I hope you enjoyed. I had a good time. And you could join the team in 10 minutes on the morning edge. Adios. Interesting and excellent interview with this guy. I love Lakshman. I'll see you guys.
Hey traders, this is Blake Morrow with Forex Analytics. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.